Well, economists are warning Australians to expect further interest rate rises after higher than expected job figures were released yesterday. New Zealand, meanwhile, has entered a recession and there are fears Australia is about to follow suit. Joining me now live is senior economist at ANZ Bank, Adelaide Timbrell. Adelaide, good to see you. Thanks for joining us. Is Australia creeping closer to a recession?
Look, the Reserve Bank is trying to forge a narrow path between avoiding recession while still getting inflation back into the 2 to 3% band. We think that Australia will be able to avoid a technical recession, but that narrow path is getting narrower by the day. What we've seen in the latest data is incredibly resilient labour market outcomes, very, very strong growth in unit labour costs, as well as re-accelerating inflation according to the monthly data. All of this points to inflation continuing to be an issue, which means the Reserve Bank will have to destroy more economic activity in order to get inflation where it needs to be. It's not yet the recession we need to have, but it's getting closer to the risk of that outcome.
Okay, so you said that pathway is getting narrower. So what can be done to slow that trajectory, or is it now a case of it's too far gone?
Look, I think that, productivity growth is really the big thing that we're not seeing in the economy at the moment. So one of the big issues that's creating such high inflationary pressure is that the cost of labour to do the average unit of output, whether that's making a coffee or manufacturing something, is going up really, really quickly by about 8% over the last 12 months. Now, that's not because wage growth is 8%. That's because our average productivity is actually going down. We need to see that change. One of the ways that changes cyclically is rising unemployment, but our unemployment rate has actually been falling. So we're just not seeing the signs we need to rely on productivity growth. The only other thing we can really do is destroy consumption and destroy economic activity. Now, that sounds worse than it is. We've had very above trend consumption and above trend economic activity for some time. The Reserve Bank is trying to slow that down, but they're going to have to work harder given those persistent pressures. Really, when we take out population growth, we are going to be going into a per capita recession this year. The amount of economic activity and consumption per person will go down. But, per capita recession, it sounds scary, but we had one as recently as 2018. We had one in 2004. We had a little one in 2008 as well. It does happen every now and again in Australia. And our extremely strong population growth is what protects us from that headline recession label.
Look, that certainly sounds like good news. If we look across the ditch to New Zealand, of course, they've already got into a recession. What's led to a recession there, and how does that differ to Australia's current situation?
So in New Zealand, we saw very, very strong increases in economic activity in a really short amount of time. And because economic activity can go up and down with demand, it means that businesses are either getting close to bursting at the seams or further away from bursting at the seams. Capacity constraints or businesses not being able to keep up with demand is what has put a lid on New Zealand economic growth. Now, we're not quite at that point in Australia in terms of our capacity utilisation and capacity constraints. But unlike New Zealand, we haven't gone as hard on the monetary policy side either. They've had to do a lot more interest rate hikes in order to reduce demand in the New Zealand economy. And being a smaller economy too, there's just a little bit less flexibility there. So we think we will avoid a recession. But when we look at the per capita numbers between New Zealand and Australia, the stories start to converge a little bit more because economic activity per person will be going backwards in both countries, whether it's later this year or early next year.
Let's go back to the unemployment figures that you've mentioned. They're again very low, dropping to 3.6% overall for May. Given the current economic circumstances that Australia is in, was that surprising?
It was a little surprising. We did expect to see unemployment maybe closer to 3.7% for the month. But what it shows us is this incredible resilience in business demand. And so what we're seeing is that the average business, their problem is not enough customers. It's actually not enough workers. ANZ Indeed job ads data shows that the number of job advertisements across the Australian economy is actually 52% higher than it was before COVID. And that's after, 134,000 jobs being filled in the past 3 months alone. What I think was really telling about that data is that the participation rate, or the share of the adult population who have a job or are looking for a job actively, is now at a record high. And the 3-month average of employment growth has actually accelerated. So just like monthly inflation, what we're seeing is, instead of it coming kind of down like this, which is where we want to see the economy, a bit of a soft landing, we've seen this little re-acceleration. And that means the Reserve Bank's going to have to work even harder to get inflation back into the band. And when it's between inflation and a recession, inflation is the bigger risk. That's why we think the Reserve Bank has 2 more hikes to go and will lift the cash rate to 4.6 by August.
Well, everyone will be certainly watching the latest rate figures when they are released, particularly off the back of these impressive unemployment figures. Adelaide Timbrell, we'll leave it there. Appreciate your time. Thanks for joining us.
Thank you.